Hey, what's up? Thanks for joining the channel. Well, today they came out with CPI, the CPI report, and as we call it on the channel, if you've been watching the channel, you know I call it CP-lie because it comes from the government, and you know we can never trust these numbers from the government because half of them are cooked and made up. But basically, as predicted, the CPI came in a little below what we had last month. And so let's take a look at that right now. Here we go to the what the government puts out here. Let's take a look at what they're calling the major categories, which is basically the overall CPI. It came in at 3% annualized. When we look at major categories, it was 5.7%. That includes primarily food. Energy was down, and that accounted for most of the decline in CPI. And basically we have major categories, which includes food and energy, which was down to 4.8%. But of course, as with everything, the devil is always within the details. So let's go to the details right now. Here you look at all the different categories, and this is going to prove what I basically think, that you can't look at the headline number of 3% because a lot of the decline in the headline CPI number is due to energy going down. And you can see from this, you have all items, which is the 3%. You have food, which overall is 5.7% increase, right? But when you look at food away from home, 4.7. Food at home, 4.7. Food away from home, 7.7. Overall, energy was 16.7. But when you break that down and look at the components, take a look at what you have here. You have energy commodities down 26.8%. You have gasoline down 26.5%. You have fuel down 36.6%, right? And energy services was basically flat. So you can see that this indicates that much of the decline in the CPI, going from where we were before, is coming from energy declining. And what you're basically seeing in all these numbers is that since the economy is composed of goods and services, what you're seeing is goods coming down rather rapidly, and you're seeing these services continuing to go up and rather dramatically. And you can see that in these numbers as we continue down here. Okay, so commodities, let's see. Let's take a look at this. New vehicles up 4.1%. Okay, this is a trend that we've been seeing for some time. The price of new cars is just completely skyrocketing, combined with increasing interest rates, causing the affordability factor to be very, very difficult. You got to spend $1,000 a month to get a freaking car these days. And look at used cars and trucks down 5.2%. That's interesting. I think that's an indication of distress and also tightening credit. That's an example where demand is actually getting decreased due to the financial conditions that we're experiencing with all the rate increases. Apparel, though, still up 3.1%. Medical care up 6.2%. Shelter, this is incredible, 7.8% up. Shelter. Okay, that you can't get much more basic than that. And transportation services up 8.2%. Okay, this is really, really incredible. And one of the reasons is because the employment situation continues to be extremely tight. Earlier this week, the government announced that the economy created 209,000 jobs. The unemployment rate is at 3.6%. This is a little bit tighter than it was last month. I think it was 3.7 last month. So employment is extremely tight. So what you can take from this is employment is still extremely tight. The unemployment rate is still extremely low, something like a 40 to 60 year low in unemployment. People are employed. The aggregate demand of the consumer is still very high, and this is continuing to push up the services sector of the economy. This is continuing to put pressure on the Fed to continue to raise interest rates, but the thing that I always try to emphasize on the channel is that you shouldn't focus on the headline number of 3%, because when you take out food and energy, for those of us that don't eat or heat our houses or cool our houses, core inflation is still roughly twice what the Fed's target is of 2%. So this shows that inflation is still extremely sticky. It's extremely problematic in the economy, and it's going to cause the Fed to continue raising rates for longer than most people think. So to delve into this a little bit more, let's take a look at the energy sector in a little bit more detail. All right, here you have the commodities chart, right? And look at crude oil. Okay, crude oil weekly up 5.06%, but look at the year to date. Oil year to date is down 17.44%. Okay, natural gas down 60%. Gasoline down 13.92%. Heating oil down 27.63%. Look at this. Coal down 69.25%. So you can see the energy complex is what's driving a lot of this reduction in the headline CPI number. Okay, now what is the implication of this? The implication, of course, is stagflation. Okay, stagflation is continuing high inflation with weakening or deteriorating economic strength, and that's basically what we're seeing today. We're in the mid to early stages of stagflation, and I think what we can expect going into the third and fourth quarter of this year is a recession. Okay, now the degree to the strength of the recession, we cannot predict at this point. There could either be a severe recession going into 2024, or there could be what they call a soft landing, right? Soft landing, if you think about it, is the worst of all worlds, because it will continue to keep aggregate demand high, unemployment low, and you'll continue to get this strong aggregate demand, which will continue to push up inflation. Also, you know, energy could spike for whatever reason, geopolitical. You know, the economy could turn around in China, and demand worldwide could spike. OPEC could continue to reduce capacity as Russia just cut capacity. I mean, any number of things could happen where energy could spike, and all of a sudden the headline number will go up again. So I don't think we're out of the woods yet. Probably the worst thing to have happen would be a soft landing. I think if we had a severe recession that just basically wiped everything out, and unemployment went up to 5-6%, I think that would be the best thing to happen here, even though a lot of people would lose their jobs, which of course is terrible. But the path that we're going on now with this anemic Fed raising, this incremental Fed policy of raising rates, dribbling out the rate increases a quarter point, you're just prolonging the pain. and you're not getting to the crux of the problem, which is too much aggregate demand, and that's directly related to the tightness in the employment sector. Okay? Now, what does this mean for the market? What does this mean for us as investors? I'm still in energy. I still think energy is a good place to be. Haven't given up on that yet. I think if we do go into a severe recession, I'll have to revisit that because it'll affect the demand side. But I think that energy is still going to be strong, and because it was so weak year to date, I think there's a lot of opportunity for that to expand. I still believe that if you have to be in the market, you should be in these high-tech growth stocks. I think with the multiple expansion that we've seen year to date, it's still a good place to be. Even though we could be going into a recession, there's still a tremendous amount of speculation in the market and bullishness in the market. And the way I would take advantage of that bullishness is to be in these big tech names: Apple, Google, Microsoft, Nvidia. I'm getting very interested in Nvidia, and I'm going to be doing some more research and content on this channel. I think Nvidia is a very good long-term play. Great way to play tech, great way to play AI, and I'm going to be coming out with a lot more content on that, doing a real deep dive into Nvidia. So that's really the update, on the inflation picture. Inflation is still with us. Inflation is going to be stubbornly with us for a relatively long period of time. Don't expect interest rates to come down anytime soon. They're going to be higher for a lot longer than most people expect. And in fact, they're not going to materially come down until the Fed acknowledges that we're in a very severe recession, and there are a lot of job losses, and that unemployment level ticks up to 5 or 6%, then they'll certainly stop raising rates and start lowering rates. But when they start lowering rates historically, I try to keep reminding everyone, that's the time when you see the biggest stock market losses. Okay? So, hope you got some value out of this. Stay tuned to the channel for further updates. And if you enjoyed this, please subscribe and like. And I'd love to have you on board for future videos, which will be coming your way very soon. So stay tuned, and I'll see you on the next video.